It's been a tough 2022 so far for stock investors. The S&P 500 declined by around 25%. Tech stocks took the biggest hit, with the Nasdaq dropping 35%. Stocks in the IT sector such as PayPal have fallen by a massive 75%. People no doubt are hesitant, and so the question everybody wants an answer to is now the right time to be buying stocks? In today's recording, I'm going to show you why now is not the right time to be buying stocks, and how just a little more patience will do you better in current market conditions. So if today's recording helps you up your investment game, do like, subscribe and hit the bell notification. My name is Zahir Anwari. I'm the co-founder of SublimeTrading.io. We have helped hundreds of private investors over the past 10 plus years learn to profit from trends in the market through our simple to learn methodology. I also write for a number of publications, including Benzinga.com, and I'm regularly invited to guest speak on how everyday people can skyrocket their stock's performance, focusing on the next 3 to 5 years. So, when it comes to buying stocks, the goal is to remove hesitation and subjectivity and instead have a non-emotional, objective approach that establishes high probability environments where you have more chance of making a profit than a loss. In other words, having an edge. This is the foundation a portfolio is built from. You must have an edge. You may have heard me say the expression before: if you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. Now, an edge covers the following points. First of all, does the asset you are looking at have a history of performance? If it does, then there is a high chance that the asset will perform going forward, returning a profit. Secondly, is the asset setting up right now to repeat its past performance of returning investors a profit? If yes, then we must get ready to take a position. If not, we stand aside and look at other assets. It's really that simple. If you consistently choose the wrong assets, you will never make money. If you consistently choose the right assets and then know how to extract profits safely, the profit will come to you and in abundance. Now, the best way to identify an edge for us as busy everyday people is to use technical analysis, which just means using charts to make our investment decisions. Now, why is that? Well, it's simple to learn and execute. It is proven and it has a rich history. Technical analysis has been used by some of the finest investors and traders since the dawn of the financial markets. Okay, so let's switch over to the charts, and I'm going to show you why the S&P 500 is not displaying an edge and why now is not the right time to be buying into stocks. Okay, so this is a typical 3-screen setup of mine when I'm conducting my analysis. I use this same setup whether I'm looking at the UK stock market, the US stock market, commodities, currencies, which is the Forex market, and also the cryptocurrency market. In the top left, I have the monthly time frame. In the top right, I have the weekly time frame, and down here across the bottom, I have the daily time frame. Notice I'm looking at the higher time frames. Why do I look at the higher time frames? Because this is where we can clearly identify our edge, and where an edge has a history of playing out and returning very, very good profit. It's also the time frames that allow us to do less work to make a lot more profit. Where people tend to go wrong is they tend to go down to the lower time frames, 1 hour time frame, 15-minute time frames, 4-hour time frames, looking for these intraday moves where they can make a lot of positions or take a lot of trades and make a lot of profit over a high number of positions. It's a very wrong logic. What you want is to do less work to make more profit, and the way to do that is by focusing on the higher time frames. So let's start with the monthly time frame. Now, the monthly time frame is a very clear time frame to identify straight away whether an asset is displaying an edge or not. One of the easiest ways to identify if an asset is displaying an edge is if it's printing new all-time highs. So if we look at the marker here, we've got the high of last year, which is this green line, and we've got the low of last year, which is this red line. And if we look at the decline of 2022, it is within the high and the low of last year, which means that we're really in a sideways market. A sideways market is really environments where you want to be standing aside. Now, it's important to understand that the S&P 500 is not an asset that you want to buy into. It is a great way to start investing if you're a beginner. All you need to do is transfer your money every month into an S&P 500 tracker fund. and whatever you get returned over the next 10, 15, 20 years is what you get returned. However, for those who want to take it that little bit further, you don't want to be investing in the S&P 500. What you want to be doing is looking at the S&P 500 for overall market conditions. Is the S&P 500 trending, i.e. is it bullish, is it bearish, or if not, then it must be going sideways. If it's going sideways, stand aside. If it's trending either to the upside or the downside, what we want to be doing is looking for stocks that are performing better than the average. Remember, the S&P 500 is an average of 500 stocks. That means there will be stocks doing better than the average. So if we can identify market conditions using the S&P 500, we can then use a scanning process and analysis process that identifies stocks that are performing better than the average. Now, all of these techniques are very simple to learn. It's just that people aren't taught it. It's not part of the schooling system. So you have to go about your own way looking for this information. Hopefully you land on this video and this helps you to take your knowledge that little bit further. So what we want to be looking at is whether the S&P 500 is displaying an edge, displaying a direction. If it's trading inside the annual levels of last year, then generally that's an environment where you want to be standing aside. However, what we do know is that the S&P 500 has a very good history of performance. I mentioned that earlier. We want to know if an asset has a good history of performance. Yes, it does. You can see that when it trends for very long periods of time. Even in bear markets, here's the bear market of 2000. Here's the bear market of 2008. You can see that these declines happened over many, many months. This most recent bull run that price has been in, which is from the low of 2009, this is a huge bull run. Even the declines around COVID-19, which is here, February and March of 2020, this was quickly absorbed into the bull trend, and the market just continued on its climb. It created an all-time high at the start of this year, and then price fell by that 25% marker, 23 to 25% marker that I mentioned earlier. Let me just do that again. Okay, more importantly, price is still inside the annual levels of last year. And also, if you take a little bit more closer look, if I just expand the chart, we can see that if you look at the month of June, which is this candlestick here, there is a wick. There is a body, and then there is a wick. What this means is that the bulls have started coming in and pushing price up. If you're new to candlesticks, don't be too confused with what you're looking at here. Green just means the buyers have been in control. Red means the sellers are in control. Now, the reason why there was a wick is because the current price, which is this point here, was actually at this low point here. The bulls came in and started pushing price up. Now, where did they start coming in? At the low of last year, which acted as a support level or a floor. This gave incentive to the bulls to start coming in, and the buyers have come in and started pushing price up. Is that a reason to start buying into stocks? Not just as yet. So if we go to the weekly time frame, we can get a clearer picture. What we have, which is positive, is that price is trading above the daily 200 simple moving average. The 200 simple moving average gives you the average of price over the last 200 weeks. If price is trading above the average, which it is, that means overall it has a bullish bias. If it's trading below the 200 simple moving average, that means overall it has a bearish bias. For now, price has a bullish bias. However, the trend filter is red. What that means is that the current price action for the short term, at least, has been heading down. But overall, the bias is bullish. Okay, I hope that's clear. This can be a little bit daunting in the beginning, particularly if you're new to looking at charts, new to investing, trying to get your head around it. But ultimately, what we're looking for, as already mentioned, are high probability environments. And high probability environments are where we have multiple factors telling us that we're bullish, or multiple factors that are telling us that we're bearish. If we have a mixture of bullish and bearish factors, then really that's an environment where we want to be standing aside. There's no edge in the market. So looking at the weekly time frame, the trend is down. Our trend filter is red, but the bias is bullish because it's above the 200 moving average. So what we have is a bearish trend in a bullish bias. And for that reason, you do not want to be buying into the stock market right now. Same on the daily time frame. Now, the daily time frame paints a very clear picture. It's below the 200 moving average. It's below the 50 simple moving average, and it's below the 20 simple moving average. That means current price action is below its averages. again, it's not an environment that you want to be buying into. Now, of course, you can get lucky. You can jump in at this point and the market could start shooting up. And that's what a lot of people try and do. They try and guess the bottom of a market, hoping for this reversal. But remember, a bottom is only when a market dictates a bottom. This could quite easily continue dropping. What we do know, since this level here in March, price, whenever it came between the blue and the orange line, it continued to drop further. So we had this point here where it pulled in between these levels, it dropped, came back between the 50 and the 20 simple moving average, declined further. And look at this decline, it was rapid. We had a gap down, we had a gap down. Price has found support and is now reversed. It's back, is looking to break back within the 20 and the 50 simple moving average. So what we don't want to get caught up in is this trap of buying into the stock market only for it to decline against us. And by looking at the monthly time frame, there is still plenty of downside potential for the stock market to drop. Current signs are positive in that it is finding an element of support. But as already mentioned, there is no edge. And this is where patience comes in. We want the monthly, the weekly and the daily time frame to all align up to tell us, yes, overall we're bullish, or align up to the downside, so overall we're bearish. But if there is a mixture of bullish and bearish factors, we must stand aside. And this is really a challenge for a lot of people, because through our education, through our schooling system, we are taught that money is made through a transfer of time. So whatever time we put into our job, that is what we get paid. Ultimately, it's a salary. And people try and have that same logic when it comes to the financial markets, when it comes to investing. They want to try and make money every day, which is where day trading comes in, or at least every week or every month. They want to try and mimic their salary. So if you're making £2,000 or £3,000 a month as part of your salary, people then think, I don't want to go to work. I might as well just sit at home, stare at the charts all day and day trade and try and replicate my salary of £2,000 to £3,000 every month. And that is where people end up losing a lot of money. They end up losing their life. But put it this way, guys. If you choose to be a day trader, you're either going to be a lousy friend, a lousy husband, a lousy business partner, a lousy father or a mother, of course, depending whether you're male or female, a lousy employee. Ultimately, you're going to be sacrificing all elements of your life to try and make money in front of the chart. And that's how people end up losing a lot of money, and also how trading gets a very bad reputation is through people's choices. Rather than flipping it around and thinking, right, what is the correct way of doing this? People then end up just thinking this is a scam, and it isn't. We have to stay true to the principles of long-term investing, which is to play the long game. I've covered in previous videos how even using spread betting accounts and compounding will get you phenomenal results and tax-free. But ultimately, you want to be doing less work for more profit. And the best way to do that is to stay true to the principles of long-term investing and focusing on the chart. And because of that, there's an element of patience involved, because we need the right environments to set up before we start buying stocks if the market goes up, or start even shorting stocks, because you can short stocks through some of the broker accounts we have available to us today. CFD accounts, spread betting accounts, as I mentioned earlier. So once again, guys, is now the right time to be buying into stocks? The answer is no, because there is no edge. Monthly is trading between the annual levels of last year. The weekly is between the 50 and the 200, the 50 and the 200 simple moving averages. And on the daily time frame, price is below all three moving averages. At the very earliest, we want to see price move above the 200 simple moving average. That is the very earliest that we want to start buying into stocks, because that confirms that the bias has changed from bearish to bullish. What we will then have is alignment between the daily and the weekly. Both will be trading above their 200 simple moving averages. Currently, price is above the 200 on the weekly, and it's below the 200 on the daily. If price moves above the 200 on the daily, we have alignment between the weekly and the daily time frame. Now, what this will mean, though, is that price is still between the annual levels of last year, because if you look at the 200 simple moving average, it's below the low of last year. If you look at the 200 simple moving average on the daily time frame, it's around that 4,400 mark, which is around this level here. If I just get a marker, just so that you guys can see in a little bit more detail. Okay, so on the monthly time frame, if I just open up the monthly time frame, This is where the 200 simple moving average is on the daily time frame, right? This black line, this is where it's sat on the monthly time frame. If price moves above this level, then what we have is alignment between the weekly and the daily, because both are above their 200 simple moving averages. However, on the monthly, if I just open that up again, on the monthly, price will still be between these levels. Now, this doesn't mean that you can't start buying into stocks. What it means is that you're just being a little bit more aggressive. If you're being aggressive, be smart with your risk. When you're in good market conditions, drop your risk to 1% or 0.5% per position. If you're in optimal market conditions, and that's when the S&P starts printing new all-time highs, that's when you can be more aggressive and start upping your risk per position from 1.5% to 2%. Okay, so that is it for today, guys. I hope that makes sense. There is no edge at the moment on the S&P 500, so we have to apply a little bit of patience. Protect your capital. This is an environment to protect your capital. There will be good times ahead. We just need to apply a little bit of patience for the market to set up. So if you enjoyed that, guys, don't forget to like, subscribe, hit the bell notification, and don't forget to share this with people who need to see this. We do need to help people get better at understanding financial literacy and putting a portfolio together. Now, where do you go from here, guys? Go down to the description below, click on the link. The link will open up into this scorecard. Are you ready to skyrocket your stock performance? Take the scorecard by clicking on this button. It will take you less than 2 minutes to complete. At the end of the scorecard, you'll get a detailed report on your performance and the steps that you need to take going forward. And you will get 30 days access, free access to the Hot Stocks Vault. This is where we share the very 10 best performing stocks every week, stocks that are outperforming the S&P 500, saving you time and money having to find these stocks yourself. See you in the next recording.